Federal Reserve, we're going to be getting that decision later today. Most of the markets expect a rate cut of 25 basis points. We'll bring that to you early tomorrow once the decision comes through. U.S. retail sales beating estimates, 0.7% from 0.6. Let's look at the PMI numbers, Purchasing Managers Index figures for December, 55.6. If you're in the 55 region or above 50, you are expanding. If you're below 50, you are contracting. Services did really well, 58.5. It was 56.1 prior. Manufacturing, though, this is still in contraction territory. As I said, if you're below 50, you are contracting. So that's what's happening in PMI. NVIDIA has fallen into correction territory, over 10% from its November high. Got to talk about that with our upcoming guest in just a moment. And also the Dow Jones Industrial Average falling. 9-day losing streak, a streak not seen since 1978. I think the Jimmy Carter. I wasn't born in 1978. Ha! So Dow Jones, its 9-day streak, a streak not seen since the early 70s, and the losses began after it closed above 45,000 points. So very interesting stats there coming from the U.S. We spoke with Sam Jurrens, who of course is the CEO of Even Heard from Oklahoma City, Oklahoma. First asked him about the PNI numbers, and then we talked about the Federal Reserve.
It's kind of funny. In some cases, I feel like depending on the headlines, they were, a little mixed. Some talk about them beating, some talk about them being less impactful. I think something that we look at those numbers today as well and see, they're nominal, so they're not adjusted for inflation. I think if we look back over the last couple of years, it's really hard to say what retail sales are doing. I still wait for the day that we can say the confusion caused by a lot of the pandemic effect on inflation and spending in general. I'm still waiting for that day to really subside. And so, I would say nothing was materially gained, in our opinion, at least from these specific numbers.
All right. Thanks for the insight there. The PMI numbers, the Purchasing Managers Index numbers for November, I guess, some say they looked encouraging, except I guess for services was encouraging. Manufacturing, I guess not so much. What's your takeaway from those Purchasing Managers Index figures?
Yeah, absolutely. It's unusual to see. When we look at the market performance of some of the companies, you take the more output-based firms like in the industrial space, even the financial space that are doing really well. On the backside of the basic material and the energy-related firms that are not doing as well. And so when you see these numbers, they're coming from a low level still, and it has been for a few months now. So it's interesting to see the market trying to, potentially what I would say is maybe price in more strength in the future through some of those positions. But it's definitely in a decline and seems to be still there. But PMI specifically can be quite volatile. So I would say it's in a downward trend still, and we need more data to see it lift up.
Now, taking, I guess, retail sales, the PMI, as a fund manager, do you incorporate, I guess, these figures into your investment decisions? I know you talked to us about what Even Heard, does and how you pick your stocks and so on. But do those two make up, part of your investment decision with other metrics as far as the U.S. stock market is concerned?
For us at Even Heard, you kind of hit the nail on the head there. We're really focused on relative momentum versus some kind of economic input. And I would say the reason why we view it that way is different market cycles, different investment environments kind of have mixed outcomes whenever you look at just specifically those numbers. So they may be helpful in conjunction with other items. They may give you a better feel on the actual economy itself. But whenever we look at, the investments in the market landscape, for the most part, those securities are trying to predict, 6 to 12 months out. So the numbers we're getting today, would be backward looking in most cases, and kind of already priced into the market. The market's already moving on to, other variables and what they may look like in the future. And so that's why we don't put any significant weight on any data points like that.
All right, I do want to talk tech with you as an enthusiast in the tech space. NVIDIA, and we talked AI last time you were on the show, it's fallen into correction territory as of Monday. I wanted to get your observation of the pullback. Could it be profit taking? Well, what do you think is happening with NVIDIA there?
Yeah, absolutely. I do think we need to look at, the year-to-date performance it's had as well, which I think can justify some of the stall out that the stock has had, really since I think probably in May was around the peak of NVIDIA. The other semiconductors are doing significantly worse in terms of return over that period, other than Avago is one, Credo is another one that's performed well. But the semiconductor space has really had a bit of a struggle, especially AMD too. But whenever you look at NVIDIA, last time I know we talked about valuations, and it's something that I don't think they're going anywhere anytime soon. And to us, from the system standpoint that we look at, their performance still for this year is pretty robust, and not something we'd be concerned with yet. If the decline continues, that's definitely a different discussion. But definitely where the stock sits today, it's not something we're concerned with. It's what we would consider a small pullback relative to what's happened this year.
Yep, yeah, it is up over 160%, so you do have a point there. But also the Dow Jones Industrial Average, it looks like it's flirting with its first 9-day losing streak since the 1970s. Well, what's your observation of the pullback there? I mean S&P, and the Nasdaq, those are still doing better, I guess, over the last 9 days. But what's up with the Dow in your view?
Yeah, I'll even take a step further back. If you look at equal weighted related indexes, so not focusing on the mega cap related stocks, most of those have gone down in line with the Dow Jones as well. If you look internally at the S&P 500, you've got, I believe it's 60% of the components of the S&P 500 are below their 50-day average, which is pretty unique to see such a robust market, especially since the lows of August until today, to get that kind of breadth information. So it's definitely some of those bigger names pulling up a lot of the indices, more than what would be implied by the internals of the market. And I think the Dow is somewhat more affected by that. It's getting fewer of the continued gainers in there as well. But I would say as a whole, the market internally or broadly is been pretty rough over the last 9 days.
Now, I do want to get your take on what another fund manager said. His name's David Russell, head of global market strategy at Trade Station. And if we take a little quote from him, he did say essentially that the market is now not as excited as it was about the Trump trade, if you will. But let me read specifically what he said. He says, Wall Street is waking up to the fact that a Trump presidency might not be as great for stocks as some people hoped. Financials and industrials jumped on his win, but now they may have to face higher rates and trade uncertainties, and healthcare faces its greatest political risks in recent memory. What do you make of that take?
Yeah, there's a lot of truth to it in terms of, winners and losers. I know last time we talked about a lot of the, government efficiencies that they're planning to bring out, which, some of them have spoken of $2 trillion in spending cuts. I'm not sure on the specific of time frame of that, but the U.S. government's coming from extremely elevated spending levels. We're even 50% higher than we were 2019 as well, and so there's definitely a lot to cut. Well, you're going to be pulling liquidity out of the system if you do that. My personal opinion, it's for the betterment of the long term. But it's still going to have some issues, and especially when you talk healthcare as well. A lot of regulation, policy changes. I think it's kind of up in the air right now of what could happen from those policy moves. And like we talked about previously too, investments as a whole are at extremely elevated levels historically. So if history is any guide, you could have what we discussed was as a lost decade. So I think they're going to do a lot of, government-related improvements, especially, I mean, you could compare it to what's happened in Argentina, which has just been a massive turnaround. That's probably one of the strongest parts of the international markets right now. I think their indexes are up 50-75% or so. It's just been robust growth from just dismantling a lot of unnecessary government spending and policies. So we could see a long-term impact like that, but I think the timing that they're coming in to do it, I would say we're at a crossroads where markets have to digest. I think investors are starting to expect 20% returns, and that's just not normal historically. Maybe we're in a new era that is normal, but I would say there's nothing that looks like it should be twice the return of what we're used to, unless you factor inflation out of it, which inflation should hopefully, be brought down if they do truly cut spending like that. So I think there's a lot of truth to that statement, but I think as a whole, long term, the government should benefit from that, or I guess public and private businesses should in the long run. But it's going to be a rough road. I think some of the health related stuff, just with consumer staples considered to be a safe place. America has a lot of things they're talking about in terms of food regulation too, that'll be potentially coming out, and that's going to impact and be costly for those businesses involved with that. And so it's difficult to say, that's a positive expense and going to be difficult for their stocks as well. So I think, I still think it comes with a mixed bag. Regional banks continue to do good on a steeper yield curve, potentially less deregulation as well. But I think it's definitely going to be dependent on industry by industry on that standpoint.
Gotcha. Now, I'm glad you mentioned spending on the fiscal side. You also mentioned inflation on the monetary side. We've got the Fed decision coming up. How does the Fed navigate monetary policy as we move into the new year?
It's wild to watch the amount of exuberance in the financial markets, and outside of that, you look at the crypto space. I feel like I've time traveled back to late 2020, early 2021. The speculation and just crazy investments people are making and bidding up prices. And then we have a Fed coming in to cut again. And that's expected for them to cut again. I don't know in terms of precedents if anything like that has been possible, but I think, from some of those preliminary numbers, it does look like inflation is very likely to have flatlined where we are and potentially escalating. If your viewers are familiar with Trueflation, they try to go out and take, real-time data to estimate inflation as well. And that's where, they're over 3% now as well. And it's something that I think, consumers are going to have to get used to. But it is wild to see a central bank coming in to continue to ease when we have the manias occurring in some investment spaces that you only get with too much liquidity, essentially. And they're going to, they're expected to cut again. I would be very surprised to see them not cut 25 basis points. And the Fed doesn't like to surprise, the markets either. But it is a very unique, unusual environment. Short-term rates coming down, long-term rates going up. And I think, inflation may very well be going with it, which will bring more volatility if the Fed has to turn around and start cutting again, which they did in the 70s. And I fully expect, kind of a difficult investment environment like we saw in the 60s and 70s. So
it's going to be a fascinating year ahead. I'm going to be glad to have you along with us to analyze things as they move along. Sam Jurrens, CEO of Even Heard, joining us from Oklahoma City, Oklahoma. Thank you so much for your time. Really appreciate it.